For more on the Fed's decision, let's now bring in Joanne Feeney, Advisors Capital Management Partner and Portfolio Manager, also joining Sarah House, Wells Fargo Senior Economist. And as we're already seeing, the Dow up about 340 points just on that announcement, even though we knew obviously that this was expected. So, Joanne, what's your initial reaction to this? This was widely baked in at this point.
Yeah, no surprise here, and very little changing in the statement that we've seen so far. Clearly, the big news will come with the press conference. I think there was some concession to and recognition of that growth is moderating. And I think that might suggest to the market that the end might be in sight for rate increases. And we do expect another rate increase in December, potentially also in March. The Fed does have a really big challenge here trying to get this inflation under control when there are so many factors that have contributed to it, from rising wages in the tight labor market. We saw some new data on that yesterday, and also from continuing shortages in various parts of the economy. So the Fed has a hard problem. The market's finally recognizing that it's going to take some time to solve, but they now may be thinking, okay, next year may not be as bad as it could have been, with rate increases at least petering out.
Sarah, what do you expect to hear from Jerome Powell?
So I expect that we'll still hear that he is utterly determined to bring down inflation. But I think we'll also hear a little bit of a tone that we've seen in the statement here, and that we're getting to a point where we're at more of a crossroads when it comes to policy. So the committee, of course, has already done tremendous tightening to date, so raising the Fed funds rate by 375 basis points in just 8 months. But we need to take into account how much tightening has been done. And so there's going to be a little bit more nuance, I think, in the outlook. But I think it's important to remember that even as the Fed is signaling that it might be ready or might be in a place where it can begin to slow the pace of rate hikes, that the committee is far from done from policy tightening.
Joanne, when you take a look at the Dow's reaction right now, we're up just around 267 points. We were up over 300 points just a minute ago. S&P in the green. NASDAQ now back in positive territory, up just around 0.4%. The excitement that we're seeing from Wall Street, is that a bit overdone at this point, just given the uncertainty out there and the fact that the Fed is going to keep raising rates, it sounds like?
You know, I think the Fed said something that really should have been obvious to everybody that sort of understands how they work. Is they made an explicit statement that they're going to take into account the cumulative tightening that has already taken place when they gauge how much more tightening needs to happen. Now, and of course, that there will be lags, and they would take those lags into account before deciding whether to tighten any further. So, I mean, that should have been obvious to people, but I think that came as perhaps some reassurance to the market. And remember where we are. I mean, the market, the S&P 500, the Dow, the NASDAQ certainly has already traded off significantly when you think about the rate increases that were signaled starting about a year ago. And I think investors, particularly long-term investors, are looking forward and they're saying, hey, stocks have become pretty inexpensive here. At some point, these rate increases are going to cease. And in fact, we have more rate increases behind us than we have in front of us. So that rate increase headwind, particularly to growth stocks, is now going to be tapering off and potentially reversing as we get into the second half of next year. So it's a good time potentially to buy some stocks if you're a longer-term investor.
And Sarah, we did see some of the balance sheet tightening start to slow in June. How much of an indicator, though, is that of how far away we might be from the Fed perhaps plateauing or at least pivoting at some point?
So I think we're still some ways in terms of reaching that terminal rate. So right now, our expectations is that we'll continue to see the Fed hiking through probably the March meeting. But I think we have to also acknowledge that inflation is quite stubborn right now. And so we're still expecting core PCE inflation to be running a little bit under 4% annualized through the first half of the year. And so I think that's going to keep the Fed on guard when it comes to its policy stance. So still looking at a pretty tight stance of policy. And it's also not just about how far the Fed ultimately takes the Fed funds rate, but I think we also have to bear in mind how long the Fed will keep that policy rate at such an elevated height.
And Joanne, as important as this day is, it's hard not to look ahead to Thursday with the CPI number that's next Thursday. If you're Jerome Powell, what can you point to if you want to say, all right, we see inflation beginning to come down? Where?
Well, used car prices, for one, is one area, and they can go through that whole list and point to different areas where prices have come down. That's the one that consumers probably find most understandable, and they're seeing it happen, particularly if they're in the market for cars. But there are a lot of elements in the pricing figures that are starting to come down. But the Fed is also going to be aware that house prices, which have risen so much, only slowly make their way into the CPI inflation figures, and that is still a positive contributor. But if you look out 6 months or a year, they'll be able to anticipate that those also will start to recede. And that's, I think, why you see inflation expectations longer term still anchored around 2.5%. I'm talking longer term. And in the medium term, probably going back towards 4% next year. So, there's clearly signs that the Fed can point to that inflation is starting to moderate.
Sarah, what do you make just in the odds of a recession? Obviously, that is a huge concern still with Wall Street. Some of those projections have been pushed out into later next year. Where do you stand on that?
Yeah, so we're expecting that the U.S. economy will enter into recession around the middle of next year. Right now, we've seen the economy stay out of it, essentially because consumers are drawing down savings to continue to fund spending. We've already seen some sectors like housing effectively already in a recession, given how much we've seen new construction and sales decline. But I think as we get further out into next year and consumers increasingly running on fumes in order to spend, that we think it's going to be harder to maintain the growth environment that we have been. So we're already seeing labor demand begin to edge down. So we're expecting hiring to slow. And that's further going to weigh on real disposable income among households at a time when inflation, while moderating, still remains very high and is keeping real income from actually growing.
And Joanne, you've called this a market of contrast. In terms of what investors should own, as they're trying to make sense of some of the stickier parts of inflation versus some of the parts that are going down, how do you approach this if you're an investor?
Yeah, this is a really unusual setup if we do end up in a recession, which isn't looking increasingly likely. It doesn't look uniform at all. We still have some parts of the economy that are expanding. Car production, for example, still facing shortages from the chip side. Services, still trying to find enough labor to operate. And so when you look as an investor, you have to be able to distinguish which parts of the economy are going to be hit the most by inflation. And that primarily is where inflation bites the most, which is really the mid to lower end consumer, which is really going to feel that pinch. So it's going to be challenging potentially for sort of mid-range retail, mid-range restaurants to keep drawing in those customers. But the bargain opportunities, where am I going to shop to save money at TJ Maxx or at Target? After they've now cleared out their inventories and stocked the right stuff, they could be real opportunities. And we like those two stocks particularly. And then you have to look at the luxury brands, some of them continuing to do well. You have to watch the inventory situation. But the high-end consumer really isn't going to feel the pinch so much from this inflation. Gas, food, it's a small proportion of their budget expenditure, so that they're not going to be hurt that much. So it really is a time to pick and choose where to go. Favor the luxury consumer, retail markets, and really stay away from the mid-range where companies are likely to see a fall off in their foot traffic as folks go bargain shopping at a place like TJ Maxx.